we can see what's going on just by looking at that. We're having a rotation out of safe haven assets today. You can see that bond prices are going down, so interest rates are going up. The metals are selling off a little bit too. So we'll see that in the market, but you can just take a look at the heat map and kind of see real quickly what is going on in the market in any day. All right, let's cover the news overseas. The services PMIs came in. Large increases reported across the global economy. In Europe, especially, every service reading was at least stronger than what economists had expected. China was the big winner. A relatively explosive reading for 55. Remember, that's over 50, which is expansion in May. We only had 36.9 in the US, although it was a sequential improvement. The market narrative is we are looking for just improvement.
And the developed markets and emerging market stocks are actually flying over the last 5 days, up 6% on developed markets and almost 8% on emerging markets. So
yeah, we're going to talk about the Eurozone stocks and emerging markets to your point, Lou. I've got some good data on the EEM coming up here, so stay tuned. All right. We also had good news. We'll take a look at the cars ETF. Auto sales are going relatively strongly, especially in China, where they have the highest auto sales in over a year. There have been sequential rebounds in March, April, and May. Remember, their peak of the virus is in February. Okay, German officials have yet to agree to fiscal stimulus, but there is expectations for the country to lift its ban on travel from other EU states on June 15th. Italy reported its lowest unemployment rate in 12 years, but that's due to a drop in the number of job seekers, though. So that's not exactly what it appears. There is the happy thought, though, that the ECB is going to announce its pandemic emergency bond purchase program at tomorrow's meeting. So keep your...
Yeah, and if you're looking for a time on that, that's at 5:30 a.m. Pacific time tomorrow morning, and that should be a market moving or potentially a market moving event. That's when the press conference kicks off.
Very good. Well, thanks for that. Regarding the virus, Dr. Fauci is expressing some concern about the level of protection of the vaccine. He said it may not be permanent form of immunity. Dr. Scott Gottlieb, who was the former FDA commissioner, had an interview today with CNBC and said that probably a coronavirus vaccine is going to be more in line with seasonal flu. You'll probably need it every year, unlike the vaccines for smallpox and polio, which provide immunity for life.
Yeah, on that, Lee, CNBC put out a survey, or they covered a survey on how many people would actually take the vaccine. And I was surprised to see how low the numbers were. There's only like something like 30% would certainly take it, and something like 15% maybe.
Yeah, that's kind of weird, isn't it?
Yeah.
All right, domestic. Let's see what else is going on here. Oh, we mentioned this. It's just a fun fact, and I don't think it's actionable. But if you've been depressed lately with civil unrest and the virus, you're not alone. Pfizer said they're running out of their widely selling antidepressant.
Oh, interesting.
Yeah. So it's Zoloft is the one. So yeah. So people they're running out of it. Okay. Also, what we have here today is in Fed speak. St. Louis economist Yi Wen said that negative interest rates is what it would take to achieve a V-shaped economic recovery. This is kind of interesting because all the other Fed speakers have been saying we're not considering negative interest rates, but he works for the Fed, the St. Louis Fed, and he said, quote, "I've found that a combination of aggressive fiscal and monetary policy is necessary. Aggressive policy means that the U.S. will need to consider negative interest rates and aggressive government spending, such as spending on infrastructure." He cited historical examples, such as President Roosevelt's aggressive fiscal stimulus during the 1930s and the huge surge in spending as World War II began. We also had some domestic economic news. New orders for manufactured goods declined 13% in April as expected. But the key takeaway here is the weakness was driven by durable goods orders, mostly in transportation equipment orders, which is not surprising given what's going on with the airlines. We also had the ISM non-manufacturing index rebounded. It's still below 50, as I mentioned earlier, but basically there is sequential improvement. Also, this just came across the news. The Trump administration is now banning Chinese passenger airlines from flying to the U.S. starting later this month. A move that comes as Beijing had said they wanted to prohibit U.S. airlines going to China, they say because of fears of coronavirus. The order, which was published today, takes effect on June 16th, but could be moved up. All
Yeah,
right.
when I look at the airline stocks, it looks like they're not really listening to that, including United up over 10% today.
Yeah, exactly. We had somebody said that here, join Wisconsin. You want me to repeat what Dr. Gottlieb said? Sure. Let me just find it here. Okay, he said that a coronavirus vaccine will probably need to be administered every year, like the seasonal flu vaccine. And Lou had said, go ahead, Lou, what did you say that on that people aren't going to take it, right?
Oh yeah, the numbers that CNBC reported on how many people would certainly take it compared to most likely take it was under 50% combined, which I thought was much lower than I would expect.
Yep. All right. Let's go here, and I want to start with the dollar. Continuing to go down. I told you about the euro. That you might want to watch that. Continuing its rise. I also showed you a few days ago, didn't want to trade the futures, you could trade the ETF. So this is working out.
Yeah,
Not that we give advice, but we do point out things that we see, right, Lou?
euro to the dollar is at $1.12 now, which is the highest I've seen it in quite some time.
Yep. All right. As I said, it's risk on today, so the safe havens are going down. Lou and I were talking about gold here. If you're trading as a range, Lou, what were you saying about the gold here?
Oh my gosh, gold on its look at this, under 1700. This might be the first close under 1700 in just about a month if it continues to stay low at these levels. And if you look at that previous high, it hasn't made a new high in looks like close to 6 or 7 weeks now. So a couple ways to play this. One, I would look that solid yellow line that Lee drew as support. A shorter term trader would look to exit the position if it breaks that, but maybe 1 to 3%. If you're a long-term buyer of the precious metal here, you might consider owning 3 to 5% of your portfolio in it and stay the course long-term, not really worry about the shorter-term movements.
Yeah, I think the lower interest rates that we're seeing are still a tailwind on the metals in general, although we are getting a rotation out of it today. Let's put up the people don't always trade the futures. Kind of the same story on the ETF. Line in the sand there is 157. All right, let's take a look at the gold miners.
So Lee, when you're looking at GLD there, how do traders place their exit strategy? Let's say we put a stop in that line in the sand of 157. Do you recommend that they put it right below 157, or a couple pennies, a couple dollars? Do they use an average true range? What might be a method to figure that out?
Yeah, I think, I mean, gold's kind of volatile, so I think I would use an average true range. Let's just put that up there. And why don't you explain what that is, Lou, as I put it on the chart?
Yeah, so Lee clicked on view all studies, and then he's clicking on a volatility study for average true range. And this is going to show up in the bottom of the chart in a study window. And by default, you have too many things in there. There you go.
There you go. I'm gonna make it yellow so everybody can see it.
Yeah, by default, it's 14 periods on a daily chart. That's 14 days. But what that's looking at is the average, lots going on there.
Yeah,
It's
let me
looking at the average movement on any given day, and it includes gapping up and gapping down. So Lee, you and I actually, at the end of March, we were one of the only people to say expect less volatility in the future. And sure enough, not only did we get it in the precious metal here, but we got it in the overall markets. So you can see that ATR, or average true range line, in yellow on the very bottom, declining. And that tells you on average how much does it move in a day, including gapping up and gapping down.
Right. So if you were going to use that to your good point, Lou, that line in the sand is 157. If you wanted to give it a little wiggle room, maybe you put the stop a little bit on, it's 233. Was that 223? So maybe put it 2.25 underneath that.
Yep, that's one method traders do, and using that tool, average true range. Thanks for showing it, Lee.
Yep. All right, let's take a look at silver. Silver has certainly caught up. We looked at the gold silver ratio over and over, suggesting it was going to catch up. Now, though, it is looks like it failed at resistance.
This is a 6-month chart. If you're watching at home, there on the bottom right, you can press the HD button, and that'll allow you to go to a more detailed resolution view if some of the lines or numbers are blurry.
Yeah, so I would say you want to watch this level on the future. Shade over 17, was that 1730? Let's take a look at the ETF. Kind of the same thing. Again, that's kind of interesting though. It bounced off that support a little bit. Right there. Take a look at the silver miners. They had a little bit of throwback. But if you like them, they're at least holding longer term support and they seem to be bouncing off of it. You could do it as, like you were saying, Lou, maybe do a range trade on this with a stop underneath there, right?
Yeah, I like this chart a lot better. Wow.
Yeah. Yeah, so something, wouldn't risk too much down to 33.45, and you got pretty good risk to reward to the top of the range. All right, now.
Just for fun, where do you think, where's the 50 on that? 50 SMA?
Kind of far away. Let's look at the 20. The 20 is right there, though.
Looks like it found support there a couple of times. Let's see if it closes above it. That'd be interesting to keep an eye on.
Yep. All right. So I want to talk about emerging markets.
Bum, bum, bum.
Bum. They've been on a tear. Broke through resistance. Now the question is, of course, this is one of the really quickest 3-day rises that they had. So is it overbought? Does that mean it's going to reverse? Well, I don't know. Let's take a look. So we had 3 sessions in a row with at least 1.7% gain. Now this ETF has been trading since 2003, and this ties its longest streak of days with gains this large. That begs the question, of course, well, what does it mean, Lee? Well, the other 5 times it put together streaks like this, it continued to rise in the months ahead each time, averaging an average return of 13.6% higher over the next 2 months. 6 months later, the average was 29.9%. If you're interested in the dates, they were November 1st, 2005, April 2nd, 2009, also September 8th, 2009, February 17th, 2016, and now. So what that means is that maybe you don't want to fight the trend on this one. See where the 10-day moving average is.
Yeah, and keep in mind, emerging markets have underperformed for close to a decade. I've seen people extremely bearish on international stocks or emerging market stocks, and that usually makes me want to look at the charts and wait for it to reverse, and that's what it looks like we're getting right now.
That's right. One of the other reasons that we are going higher, of course, is the drop in the dollar. Generally speaking, emerging markets trade with a negative correlation to the dollar. Why? Because they've got a lot of dollar denominated debt. It's easier to pay back. um, when it is in dollars. Okay, the other thing, I hate to pat myself on the back, but I'm going to anyway. I told you about the euro. I told you about the Euro stock 50 a week ago. Um, and we now have sentiment support for this move. Let me tell you what I mean by that. Okay. Um, so the latest survey, we have a monthly survey from the Bank of America Merrill Lynch of active money managers, and that showed yet another month of them preferring shares in the U.S. versus anywhere else, especially the Eurozone. Through mid-May, the survey showed that managers were 24% overweight the U.S. and they were 17% underweight Eurozone. That's more than a 40% spread. That is the widest in 8 years. Looking back historically, this has been a very decent contrary signal. When the spread was very negative, the ratio of the S&P 500 to the Euro Stoxx 50, which is what the FEZ is, tended to bottom and higher for several months. So again, they may be having the pain trade here. If it keeps going up, they're gonna, and since they're so underweight, they're gonna have to rotate into there. So kind of interesting. Also, if you want to see how much they hate the Eurozone, they prefer US bonds over Eurozone stocks. And it's very rare to see a bond market take preference over a stock market among stock fund managers. I think they might get squeezed in this one.
Lee, would you mind overlaying the SPY on top of this?
Yeah, do you want the price relative or just on the same screen?
Just on the same screen. Overlays on the top right. You could click on the ticker SPY, and then go ahead and take this back 10 years. I really just want to make the underperformance point. So look at that 10-year underperformance of the S&P compared to the Euro Stoxx 50.
Yeah, that's an excellent idea to show that chart, Lou. So there's some real upside. Oh, I mean, this is the FEZ. You wanted emerging markets?
Oh, no, that's fine. They're all going to be about the same.
Yeah, we'll put up emerging markets too. Just the same thing. Same thing you're talking about, Lou.
So in blue on the very top, that line that's up almost 200% is EEM. Oh, I'm sorry, is SPY. There you go.
Yeah, this is the overlay SPY. That's up. And of course, EEM is only up over 10 years, what?
Hasn't done much.
8%.
Yeah.
8%. Yeah. So anyway, there you go. All right. Let us move on. And again, let's take a look at the bond market real quick, Lou. As I said, it's kind of risk on today, so they're probably selling some bonds, maybe to rotate into stocks. You can see a nice move higher in the 10-year yield. Look at that. And as you pointed out to me, we should look at the yield curve, the 2x10 yield curve, which is bear steepening, which is what you want to see. You want to see the 10-year yield go up faster than the other yield. So let's pull up that chart. You and I were talking about it. It has improved quite a bit, and as you said, Lou, it's given a tailwind to the financials. And we'll take a look at
Yeah,
those.
that 210 yield spread is now the steepest it's been in quite some time.
Yeah,
We
you
had a
can see this.
blip here earlier this year, but if you look back, these are levels, right?
Yeah,
You could see it trending lower. That's why we're looking at charts. We saw there in about September where it turned around and started trending higher. And yeah, we're seeing financials start to work, insurance companies work.
yep. Okay, let's look at our bond signal. It might be ready to switch here.
And this is something that should be interesting where Jeffrey Gunlock from Value Line, excuse me, where is he at? I always get this wrong.
Double line
Something,
capital.
that's it, Double Line. He's been talking about the risk in bonds is having yields go up on the backdrop of the US dollar getting weaker. with the theory that these other countries that have been buying US debt or even corporate debt here in the US, they have not been hedging it due to the high hedging costs. And if the US dollar starts getting weaker, then that's really going to hurt their investment in US bonds. So it should be fun to pay attention to see if this spike in yields keeps going. It
Yeah.
looks like we're right at the top end of that range that we've been in since the beginning of April.
Yeah, and it looks like another couple of days of weakness like this in the TLT, and we're going to get a sell signal on that. Still be a pretty good trade though, 137. There you
And
go.
what you're using for this signal here is on a daily chart. You're
Right.
looking at the 20 period exponential moving average and the 50 period exponential moving average. And when that shorter moving average crosses above, that's your long opportunity. When it crosses below, that's your avoid or short opportunity, right?
Right. Why those two moving averages? Because the back testing showed that for at least for this particular purpose, uh, works okay. If you went back in time, you'd see that it is a very good signal. We don't give advice though, but it's something to keep your eye on. Okay, let us look at the uh, market, and Lou, I'm going to make a naked chart here, and then you just tell me what you want to look at, and we'll put it on for you.
So Lee, when we're looking at the S&P 500 here, the question everybody has is how can it keep going up? I just don't believe it. We have questions coming in here about the NASDAQ specifically, but I think it correlates to the S&P 500 as well. So many companies without earnings trading at these astronomical prices, or people are fearful of what's to come. How can the market keep working? This is the perfect time to trade on the long side when everybody out there is so bearish. When the market's working, you just don't want to believe it. That should be your opportunity to look for, okay, let's get out there and buy things, but let's have an exit strategy in case we're wrong. And things that go up can continue to go up a lot longer than we think they will. Historically, that's always been the case. People have been very bad at predicting where the top is going to be. And therefore, that's why we're looking at charts. Get into what's working and have a walk away in case it stops working. So Lee, I want you to put on just the basic moving averages on this, including a study below RSI. And you don't actually even have to put RSI up there, but I just want to ask you a question. With RSI approaching 70, which is considered overbought territory, how worried should somebody be getting into something like the SPX with RSI right around 69 today?
Well, certainly it means that you're entering what is technically known as overbought territory, but I make the point that we have switched from bear market to bull market behavior. Um, Notice that every single pullback has not had the RSI go anywhere near 30 since April, uh, and now we're in overbought. As Mark Idam said, there's been a lot of study on the RSI. Uh, in bull markets, you get up to 70, you don't get down to 30 in pullbacks. In bear markets, you get down to 30 and you don't get much past 50 on rallies. You can see it classically here. So while it's overbought, it can stay overbought for a while. I mean, take a look at here. It was over in this bull market. It was over 70 and it kept going up, right? So,
And that's a key point, right?
yep.
Just because it's overbought doesn't mean it has to go down. In fact, in strong bull markets, it can stay overbought for longer periods of time. Therefore, you always want to look at the chart first before in this case, RSI. If we're in an uptrend, that's telling you, look, it's strong. You got to be careful shorting it. I
Mm-hmm.
wouldn't short it at all. Traders wouldn't short it, generally looking at the technicals. You want to own it, you just need to have an exit strategy for where you can admit you're wrong. And this thing keeps working, and it looks like we want to go up and test those all-time highs.
Yeah, it is crazy that way. The market is shrugging off everything. Again, you got to trade what you see and not what you believe. We see that it's going up to Lou's point. The trend can go on. The other thing that I found very interesting on the market, I'm going to go to another chart here.
I think last week we talked about the S&P taking out the 200-day moving average. It's now above all major moving averages, which is no doubt a bullish.
Yeah. Now, what is this chart? This is the ratio of advancers to decliners on the New York Stock Exchange, smooth with a 10-day moving average. We've gone from below 40 to basically 65. Okay. That is quite a breadth thrust. Now, it's not as wide breadth thrust, but it is quite a. And I'm just looking at data. The few times that this has happened, when you go from basically 40 to 65 within a few weeks, 3 weeks is kind of the cutoff. Since 1962, you won't believe this. A week later, the market was higher every single time. 2 weeks later, it was higher 83% of the time. 6 months later, it was higher 100% of the time. A year later, it was higher 100% of the time. So again, maybe you don't want to fight the tape. That's all I'm saying.
Yeah, I was talking to
Okay.
a friend of mine, and he was saying, look, you can't invest at this point because the market's moved too far too fast. And this was about 500 S&P points ago. But his point was he was looking at it on a quarter by quarter basis. And he was saying, look, results are going to be very bad. But if you think about how a company is valued, it's not valued based on the results it's going to produce that quarter or even that year. You own the company and you're including all of the future profits or losses of that company. And if you think about what we saw from COVID-19 is it's really sped up the adoption process that many of these technology companies were trying to gain or try to get people to do. If you even look at a retailer like Target, for years they were trying to get people to shop at target.com, and slowly but surely people were adopting the online way to shop at that particular retailer, and this just sped it up. More than ever do people have accounts that they can get delivery from these firms. So this has really just sped up the future. So be careful looking at such a myopic view of what's happening right now and think about how this might actually be beneficial for companies in the long run.
Yeah, speaking of that, I think you're right on, especially if you look at the QQQs are at all-time highs, or right at it.
Yeah,
Now,
and I do feel like our comment here that it feels like we're almost at these astronomical prices here, and I definitely agree. But when it's working, you have to trade in the direction of the trend. And just keep in mind, people are not overly optimistic. From the people I talk to and meet with every day, from friends to you at home, people are not overly optimistic. They just don't believe this run. They're reserved. They're stuck on the sidelines, and that leads me to believe that we could continue higher. Right? That's the pain trade: is higher, not lower.
that's right. If you're trying to manage your risk, certainly 10-day moving average has been working for this entire run. So, you know, just something for a short-term trader. Anyway, I got a question. When I use my historical studies, what software do you use? I've got a few friends to give me some stuff. I don't do it myself, but they have huge databases. As I said, uh, the I have the Dow Jones. I do a lot on Excel too, though, because I have the Dow Jones every day since 1900. So you can just do it on Excel also. But for a lot of these, I don't bother because I have friends to do it for me.
Wow,
Okay.
you and Beyonce must be nice.
Yeah, yeah. All right.
So how much should we worry that we're right up here against resistance on the Qs?
Well, I mean, it never hurts to take a little bit of profit when you are testing a level. Okay.
Mm-hmm.
Uh, but I wouldn't get out of everything. To your point, it's still working. And you can always buy back if it breaks out. You can always buy back the little piece that you sold. It's usually now with the momentum we've had in this market, Usually, you'll have a test. It might not go through the first time, but you know, you can just see every time it drops a little bit, they buy it right back up. So, if you have big profits, you would maybe sell a little bit, but certainly don't get out of your position. Totally, it's working.
And remember, when we're talking charting the markets, we're talking about your trading assets, not your long-term buy and hold assets. Quit trying to time your long-term buy and hold. Have a diversified portfolio, understand your risk, understand your time horizon, and quit micromanaging it. Your trading stuff, though, yeah, by all means, trade
All right,
away.
yeah, let's take a look at the Russell. New highs. Can't go any higher. There it goes, right?
And that was beat up the most of the major indices.
And now you'd have to say we decisively broke the 61.8% retracement level from the lows. This is the last index to do it. Anyway. All right.
When we do that, do we often go back and test the 100 level?
Often, yeah. Often you move right back to where you started. Yes. It certainly means the lows are in. I mean, for that.
Yeah.
All right. Let's just see. We were talking, Lou. I'm going to give you first dibs here. What do you want to look at on the financials? You can start with the XLF if you like.
Well, XLF is something that traders have not liked for quite some time. And now with the spreads widening, it looks like we got that nice bottom there where we just really sold off, almost 50% from the highs, 40% from the highs. So yeah, nice strong rally. Looked like we were range bound last week, but nope, we took that top of the range out and we're now in a nice uptrend. This is something that buyers would be owning.
I would think so. If you want to set a target based on the measured move, it's basically 20 to 23 and a half, 3.5 points. That would take you to 28, yeah. Which makes sense. That's the last little consolidation up there.
Very tough spot to try to bet against something like this.
Yeah, and you can see that it's if we take a look at what is really moving today, you'll see it is the financials. It is the biggest change today is the regional banks, and right underneath are the money center banks. So let's take a look at a couple of those. Let's take a look at those two charts. So now if you were, I would just watch the 10-day moving average. We did take out this swing high. It'd be interesting to see if we take, I mean, we got this gap in here. It failed last time with an engulfing candle, but all that did was put it back to the 10-day moving average. I think it looks like it wants. Do we fill that gap? What do you think, Lou?
Yep, we're in that gap. Traders would look at it to fill the gap all the way up there. That green line, 43.94, looks strong. So yeah.
All right, let's take a look at the bigger banks. KBE. Same thing. And then let's take a look at insurance. Nice breakout in insurance today. We pointed this out on Trader Talk. Okay, let us see what else is moving today.
Let's take a look at XLE.
Yeah, we got a question on that too. Good call. Yeah, filling that
Just
gap.
beautiful uptrend, right? From this
Yep.
devastating sell-off there going into the March 23 lows. This nice uptrend, slowly but surely, very similar to the bank's slightly better position. I like kind of the range of this uptrend a little bit better, but it has filled that gap, or it's pretty darn close to it.
Yeah, and let's take a look at the exploration companies. Looks like they're trying to break out again. Let's take a look at the refiners. There you go, Lou, another one. So the whole group is moving, and as we saw on our industry list, oil service stocks are doing well too, right? Let's take a look at the SIH. It's a stronger signal when all this kind of the subcomponents in the group are moving well, making a new high.
Yeah, so we would have been worried about that gap level right around 117 or so, but we're now well above that previous gap resistance, and trader would say, hey, this is what we want to see. We want to see these higher highs and higher lows.
Yeah, looks to me this could run up to 145-ish. All right, let's see what else is moving.
Hey, Lee, that's a good question. Do you give more strength to breaking the top of the gap or the simple moving average as we rise above them? I personally put more weight on the gap itself because that's where, from the psychological level, lots of people, if you look at that kind of March 1st gap, that line that you drew, as we trade below that, there's lots of people that are saying, oh, you know what, I should have got out of it. As soon as it goes back up, I'm selling out. And that kind of helps create some of this resistance.
Yeah.
The idea is once we get above that, the weaker hands have finally got out. There's new ownership, new stronger hands, and usually that's what can lead us to new highs. How
Yes.
do I get the industry list through Street Smart Edge, Lee?
Well, you can email me and I'll send you the symbols. You're gonna have to put them in yourself because I've had some trouble actually sending as a watch list file. But if you want the symbols to build your own list, you can email me and I'll send it to you in a Word document. All right, let us take a look. What else is moving? Steel. Oh, look at the travel guys. So we saw, well, let's look at the airlines first. In spite of that news, they're breaking out now. And we're getting to overbought on the RSI. That is a change in behavior.
Mm-hmm. Yeah, I on Jets here, I like looking more at that 18 level as the pivot, but
Yeah, I think you're right. I mean, because that's the last really good swing high.
mm-hmm.
Yeah. That's a gutsy trade though. You don't know how many people are gonna go back to flying, but let's take a
There's
look
also
at,
a little bit more gap risk on something like that, where
yeah, yeah,
news
there's
overnight ain't could really move up or really move down.
yeah. This is kind of all the travel. It's the same thing. And let's look at when we're talking about traveling and kind of that reopening. I told you about blackjack here over a week and a half ago.
Yeah, well, some of these stocks from who is it? Eldorado's trying to buy Caesars and Penn, and all these stocks have really moved up. And really, if you remember why they sold off so much, wasn't that the casinos were closed, but these gaming companies take on a ton of debt. So anytime you take on a ton of debt, going back to earlier, the company isn't valued from quarter to quarter. But if you have so much debt that puts you out of business, that's when you get in trouble. So it's real easy to look at that low and say, oh, why didn't I just go in and buy in on March 23rd? Well, the reason is because you probably thought more than half of these companies were not going to make it through this shutdown. But with the government help, it looks like they are backstopping that.
Yeah, if you want the listing, my email address is lee.bohl, B-O-H-L at schwab.com. But you got to email me though, so I can get your email address and send it back.
Lee, let's take a look at the worst performing sector of the 11 major sectors over the last 5 days. XLV, healthcare. It was a darling, leading us higher for quite some time. Take a look at XLV now.
That is XLV.
Yep.
So it's
Interesting here.
yeah,
Lots of consolidation.
yeah, lots of consolidation. Let's take a look at the biotechs within it too. Also, let's take a look at this is a nice continuation triangle. At this point, you would wait for a breakout of the trend lines to trade it one way or the other. But generally speaking, more than 50% of the time, the thing will break in the direction it entered. That's a pretty classic symmetrical triangle right now.
You got it. Yeah, just interesting point on on all these healthcare and biotech as well, because they let us hire and they were working so much, and now they're
Yeah, it's just a
less
rotation out of what was
underperforming.
working. Now they're getting maybe that shift into value a little bit. Let's just take a look at how the growth to value ratio has been doing here.
Yeah, they're actually the worst performing sector over the last 20 days and 1 month.
Yeah. Well, it hasn't cracked that much. But let's take a look over the last few days. Let's take a look at least in the S&P 500. And we're going to compare that. So this is the growth stocks as defined by an algorithm that S&P puts together. These are the growth stocks in the S&P 500. Let's compare it to the value stocks. And it looks like I'm going to move this up. So let's close this one. Let's make this bigger. Okay. Street Smart Edge is not helping me here. Let me take it off altogether and add it again. So what we're doing here is the price relative study. It's a good way to get relative performance. So we'll do price relative versus the VOOV. There we go. Yeah, well, so that you can see that over the last few days, growth has been underperforming, right? Because this is growth versus value.
Mm-hmm.
So you can see a little bit of that rotation going on there. You just draw that in.
Yes. While you're pulling that up, someone did ask for the support level on XLV. Many traders out there would use either the 50 or the 200, and they just happen to be just about on top of each other, and really on top of the 100-day for that matter. So pick your poison. Longer term investor might use that 200. Shorter term person might use the 20 or the 50.
I give up on that. Yeah, let's put that chart back up just so we can give a visual for you. So if we put the 50 up, there's the 50, here's the 200, and then you said the 100, right?
Yeah, don't worry if you don't have it.
I got it somewhere here. No, I don't. Never mind.
Yeah, it's right at that same 96-ish level. I think officially it's at $100.42. But
yeah, and that's kind of interesting, Lou, that you mentioned that confluence there, because that's also the bottom of the range. So that is very good support on that, right around 97-ish to your point.
on your price relative, someone's asking a question, what were you comparing it to? In the price relative study itself, you could see the ticker that it's being compared to. I know it's tiny, but in this case, it was VOOV.
Yeah. What is support on XLE? Okay. I would say 39 and a quarter. Short term. Longer term would be the 50-day moving average of 35. Notice that was also right now the low of the last pretty good pullback we had.
Lee, because it's Big Wednesday, one of my favorite classes is on today at 1 o'clock Pacific time. And no, I am not the host of it. My favorite class, it's an actual class outside of Trader Talk and Charting the Markets, is Behavioral Finance. And Mr. Jeffrey Ablos is going to be teaching that with Rob Kamek out of Indiana. That's at 1 Pacific today.
Yeah. Again, if you want that list, you got to email me. I can't get it from the question. All right, our time is up. You're up next, though, even though your favorite class is after you. Right?
But top of the hour, what we'll be talking about at 11 Pacific here at the top of the hour are ETFs, and we're going to be talking about them from more of that longer term perspective. I get it. We like to trade a portion